Well, yeah, I can't see it now because the charts aren't moving for some reason. They don't actually kick in until New York opens, which is kind of annoying, but is what it is.
What was it? BOA speech.
Why do I have such a headache? The DXY on mine is cracking the support.
DXY or BXY?
D, the dollar. Oh wait, are you? Oh, did you say that?
I was looking at BXY, the pound index.
Oh.
But you know, obviously the charts aren't live until New York opens, so you can't really see too clearly. I mean, you can look at FTSE 100 to get a general idea, but oof, all the indexes are down today.
Yeah, except of the Hang Seng. Oh, wrong thumbnail. Oh, never mind. Gotta fix my C-Trade, I cannot start it anymore.
Just be that guy who trades only the gaps on indexes.
Ugh.
I met someone who tried to do that and it failed one day.
I don't like indexes at all.
This is looking very nice, but what? How many more minutes? We don't even have minutes.
Oh no, we don't. It should be happening right now, and I can't find a live stream. Yeah. Do you mind giving me a little like running commentary swing of what's going on, because I can't see it.
Swing shit's broken too. My fucking indicators are dumb too.
What's an indicator?
I don't know. Something I was told to never use. But I need training wheels.
Training what?
Training wheels.
Training wheels, you know, like they put them on bikes for kids to help them ride.
Look at that. The price is absolutely dead still.
Yeah, it's like everyone is waiting.
Yeah.
The hourglass is spinning.
Literally everyone is trying to find the fucking live stream, but no one can, so the prices are moving anywhere.
It's published last. I'm just going to ask very briefly for those watching, not necessarily in the room, if you can introduce yourselves, then we'll get straight into questions. Dr. Carney.
Mark Carney. Thank you.
Ben Broadbent. John Cunliffe.
Sam Woods.
Thank you very much indeed. Time is very tight this morning. We have a second panel of Treasury officials joining us later on in the morning. So I'm going to, I've asked members to try to direct questions to specific witnesses, but obviously if there are things that you want to add, then please feel free to do so. I want to start off, Governor, with obviously the two scenarios set out last week for disruptive and disorderly Brexit, and you emphasise that we should think of those as worst-case scenarios rather than forecasts. For the avoidance of doubt, can you explain exactly what the Bank of England means when it says something is a scenario and not a forecast?
Yeah. Well, thank you, and it's an important thing to start off on. So a scenario has first off, it's not what we think is the most likely thing to happen, so it's not our central expectation. It is a depiction of what could happen to the economy based on a series of clearly identified assumptions, and they are established economic relationships, empirical economic relationships, to map from those assumptions to potential economic outcomes. We discipline all of this by using the bank's macro model, so it's consistent across asset prices and inflation. We then use reaction functions for macro policy. So there's a simple fiscal, there's no fiscal policy response, but there is a mechanical macro or monetary policy response, and that lays out, that gives a set of outcomes. Now, this is particularly relevant for the Financial Policy Committee, as you can appreciate, because what the FPC is concerned with is less likely scenarios, tail risk scenarios, and it, by design, will look at a series of worst-case assumptions, because the position we need to be in, and I would say we in the broadest possible sense, the United Kingdom needs to be in, is to have a financial system, the core of the banking system, but the financial system more broadly, that can withstand a highly unlikely but worst-case set of events. And so that's what we've done with respect to a disorderly Brexit, what we've called a disorderly Brexit. We've cross-checked that against an even more severe stress test, which was released in parallel with this. That more severe stress test, and I'll finish on this, also has a global recession and 20 billion pounds of misconduct costs. So what you should, if I may suggest, and certainly the FPC is suggesting this, what you should take away from the worst case Brexit scenarios is that the UK banking system has the capital, separately detailed, the liquidity, the overall resilience to withstand that and be part of the solution, not part of the problem.
Okay. And what probability, I mean, I think the probability of these scenarios unfolding is important. So what probability do you attach to either disorderly or disruptive Brexit unfolding?
Well, tail risk is tail risk, so it's low probability that all of these events would happen at the same time. So, because it is not just a question of the formal trade barriers that come into play, tariffs, product standards, rules of origin, those, but also shorter-term disruptions in terms of port infrastructure, other logistical disruptions, but also a fairly severe financial market reaction and a shock to confidence at the same time. So these are low probability events in the context of Brexit. In terms of the likelihood of whether or not there is going to be a no-deal Brexit, I mean, the members of this committee are better placed to judge that.
Okay. Mr. Broadbent, the document talks about a supply shock and also obviously the GDP decline. Can you give any precedents for a decline in GDP or a supply shock of this nature?
It's very hard to give one of this nature because we've lived through a long period, essentially since the Second World War, of deepening trade integration. That's been the direction almost monotonically, first between developed economies and then latterly including developing economies as well. We picked out one particular episode of trade de-integration, if you like, which was when the Commonwealth preferences for New Zealand were withdrawn in 1973, ironically when the UK joined the European Union. I will point out that this committee, all of us, are unfortunately familiar with the slower growth in productivity since the financial crisis. That's not a negative hit to supply, but it is very much a sort of disappointment in the rate of growth. So some of the effects of that you nonetheless have inflation, but you have weak real wage growth and so forth, we are qualitatively familiar with. But it's very rare indeed, so rare that we could only find one reasonably close parallel, to have an episode where you suddenly curtail international trade.
What about the oil supply shock of the 1970s?
That has some similar aspects to it. It pushes up input costs, which is one of the effects of reducing trade. So it bears some relationship, but the New Zealand episode is the closest one we could find, and even then it's not exact.
Parallel. Governor, obviously your publication last week attracted not entirely universal praise, and you might find that some members of the committee are less than convinced by what you published as well. Andrew Sentence, for example, said that it was, and I quote, highly speculative and extreme and will undermine perceptions of, well, it says your, but I think he means the bank's credibility. How would you respond to those criticisms?
Well, I think the first thing I'd say is there's sort of two classes of criticism, if I could generalize them. One which I think is entirely unfair, and the other which is a matter of debate. The one which is entirely unfair is the fact of the publication. The fact of the publication is this committee.
We asked for it.
Yes, asked for it. The fact is we are accountable to the people of the United Kingdom through this committee, through Parliament. We don't have the luxury of holding back material which we have produced that is directly relevant to our responsibilities from this committee if it's demanded. And what's clear from the now unredacted minutes of the FPC, the so-called record of the FPC, is that we have been doing this for a couple of years. We have not volunteered this worst case analysis. We have held it back. We have used forms of words to provide comfort around the fact that we have provided or built the resilience in the core of the system. In other words, we've talked about an unrelated stress test, the ACS of 27, so-called ACS of 2017, encompassing a hard Brexit or a disorderly Brexit, to give that comfort. But it's only one part. So the first set of criticisms around us producing or us releasing,
I think is going to keep making higher highs until the speech is over, unless something is said.
Our judgment, unfair. There's a separate set of criticisms or points of debate, which is around the analysis itself, and that we absolutely welcome. Let me say a couple of things to turn back. First is, I think the analysis needs to be looked at in the round, because as you rightly started out, these are scenarios, and there is an S in scenarios. There is there are different variants of a so-called hard Brexit, disruptive versus disorderly. The differences are clearly indicated. There is also a smooth move to WTO, which is contained in the report. After a transition period, a smooth move to WTO. So again, you can isolate the difference between issues that are very short-term and potentially quite topical and significant around port infrastructure, about readiness, about familiarity of companies with custom declarations, a series of those types of issues. You can isolate those. And if you don't think those are an issue in the short term, then you can just jump to the smooth WTO scenario and use that as a base and discuss off that. So first point in terms of the substance. Second point in terms of the substance. This is, the analysis is based off of, the core analysis is based off a gravity model. The underlying data points, there's 600,000 underlying observations that are used to calculate the relationships. We disclose in the report that the elasticities are so, if you're mapping from the degree of openness, all of these various restrictions on trade, whether they're tariff, non-tariff barriers, restrictions, other things, restrictions on trade, if you're mapping from that to the degree of trade and therefore, and then ultimately to the degree of productivity, there's a range of elasticities from the empirical literature between 0.16 to 0.75. We disclose, we use 0.25. In other words, we use at the low end of the spectrum. So it's well grounded. It is, we're disclosing the key assumptions. We disclose the flows and the various relationships that are there. And then just one other point, if I could, in terms of just to go to process, which is, we had a core team of 20 senior economists who've been working on this for a couple of years. and then draw in
I think I'm about
other
to get out
professionals
too,
from across
you know,
the bank,
breaks
almost 150 professionals from across the bank have been working on, and two senior committees, the MPC and the FPC, have reviewed the work. So this is not something, there was no exam crisis. We didn't just stay up all night and write a letter to the Treasury Committee. You asked for something that we had, and we brought it, and we gave it to you.
Thank you. Well, we're very grateful, and we know that there has been a significant amount of work that has gone into all of this, say, over a couple of years. Just before I hand over to Roshnara, just one final question for Mr. Broadbent. I mean, we're going to explore, obviously, a number of the assumptions made and the modelling in the scenarios. One of the things that was noticeable was that in the disruptive scenario, you said that sterling could fall by a further 15% and by 25% in the disorderly scenario. How did you reach those figures, bearing in mind that obviously sterling has already significantly devalued since the financial crisis, but also since the referendum?
The uptrend that it made.
Since, this is my view at least, the fall since the referendum represents the market's view of sort of an average of a range of possible outcomes. And essentially, the larger the effect on UK trade, of UK
has a long way to go back if it's actually going to pull back.
Reasons.
If it pulls back, it's going to go down.
So at the moment, what is priced in to the level of the exchange rate?
It's going to go down.
There's a number of possible.
So like round, what is this?
So
1.27777.
Towards the better end of that range, you would expect sterling to rise from here. If it's towards the worse end of that range, you would expect it to fall further. And in general,
you just said fall
greater the
further
economic
for that
dislocation, the worse the exchange rate it's going to be.
Yeah.
And that's there's a sort of direct relationship between the two.
Yeah, but if I may add, there is a equilibrium current account calculate. I mean, it's grounded ultimately in a sustainable current account position.
Just imagine if someone wasn't.
Roshnara.
Good morning. Governor, last time you saw us, you told us it would take 4 years to do a trade deal and approximately half that time for implementation. Does this make the backstop inevitable?
I think what I quoted was that the experience with advanced economy trade deals has averaged 4 years, and including on average the implementation period at that time, so 4 years in aggregate. So I make no judgment about the, I mean, we're not party to the negotiations, we're not party to any discussions the government may have had with the European Union about a potential future trading relationship. Obviously, we've read the political declaration, but what's beneath it, we don't know. I take note that within the agreement, within the withdrawal agreement, there is a possibility, not a requirement, but a possibility of extending the so-called implementation period by 1 to 2 years. As you know.
But it would follow that if it takes as long as 4 years, then that would be the case.
If our trade negotiations took as long as the average trade negotiation, it would use up the time of the additional extension, the 2-year extension of the implementation period for both negotiation and implementation. If I may make a general comment, which is that implementation, there's a very practical aspect to implementation, and some of which is being discussed as we speak, which is there's implementation in terms of businesses around the country getting ready for the new arrangements, changing suppliers if necessary, developing new markets if necessary. There's those aspects. Then there's the very basic, which is relatively unusual, but necessary given our history, the very basic implementation of new customs arrangements, new port infrastructure, other practical aspects to implementation. Last point, if I may, there are, of course, those practical aspects to implementation in the financial services sector. That's the one area where we have direct responsibility, and we've been working over the course of the last 2 years alongside the FCA and others in order to make sure that the financial service sector at least is ready.
Sure, but you mentioned again in the last session that other services will will have challenges and will take considerable amounts of time to adapt to the new arrangements.
Well, it's I think it's fair to say that at this stage there are a number of industries, both manufacturing and service industries, that don't know what the new arrangements are going to be. So it's difficult. You can only start implementing when you know what you're implementing for or towards. And at this stage, it's not yet clear.
Would anyone else like to add anything to this question? Okay. So given the length of time it could take to secure trade deals, why does the bank analysis assume macroeconomic uncertainty will fall back to average by the end of 2019 in the close economic partnership scenario and at the end of 2022 in the less close economic partnership?
The close economic partnership will be a new arrangement, and our expectation is there'll be some uncertainty related to that. It's relatively modest. I believe it's half a standard deviation increase in uncertainty, which is something, but not that much. And given a big structural change, would seem a reasonable assumption. It doesn't have a big macroeconomic impact on the scenario, just to be clear. That order of magnitude of uncertainty is more directional, more a signal that there would be some. But given in the close partnership arrangement, the basic modeling assumption is that there is an implementation period between now and then. There is a reasonable sense of where we're headed. And that once we arrive at that destination, those expectations are largely fulfilled. So now, if one disagrees with that, if one thinks actually the negotiation of what the close economic partnership will not be known until the end of the implementation period, you could take that view. In which case, you would be more likely you'd be on the lower band of that swathe. That's part of the point of having these scenarios. Is it allows you to take different assumptions and have a sense of what the different potential outcome would be.
Anyone else like to come in?
So I was just going to go back to your. I was going to respond on the earlier question, but
sorry,
I didn't press my buzzer fast enough. Just to say, I mean, I think what's unusual normally if you have a trade deal, there are controls, and then you dismantle controls. What's unusual here is the spectrum of possibilities that would need to be negotiated for the future relationship involves some very different things. So in some states of the world, the frictionless trade, the customs partnership arrangement that the government has proposed, you just wouldn't be bringing controls in certain areas on the customs side or on the regulatory side, whereas in other states of the world you wouldn't, and those possibilities are there. And I think for businesses to know which one they're preparing for is quite important, because you can spend a lot of money preparing for something that doesn't happen. So I think that sort of, once it's set which way this is going, then I think businesses and others can start to prepare, but there's still quite a lot.
That's what I'm thinking. But
so are we just pushing the uncertainty further down the line then? And in a couple of years' time we'll be back to, even if the withdrawal agreement was agreed, big hypothetical, we'll be back to square one again.
I think that depends on the pace of the negotiations, and I think the government's in a better place.
If the last 2 years is anything to go by.
I think, John, if you're probably in quite a good position to know, having your senior role in Europe, for the government negotiating team as well.
Yeah, that's
not going to venture a suggestion.
I don't do that
anymore. It's crashing.
Well, I'd like to comment. Okay. So we've received evidence that the analysis of the impact of the UK leaving the EU has uncertainty with the general economic forecasts. To what extent do you agree with that?
No, Matt, I didn't.
Governor?
The analysis, I'm not quite sure the evidence you received, but let me make a comment in terms of our scenarios on this issue, which is that, as we observe in the report, so as I said to the chair, we have clear assumptions, we map those to economic outcomes, and when we vary the assumption, you get a different economic outcome. That's sort of obvious point. What we don't do is provide confidence bands around each of those paths. So as you know, when we have our latest inflation report forecast, we will have a so-called fan chart around that forecast. Now, that forecast, that fan chart takes into account a couple of things. One, kind of from a fundamental perspective, things happen in the future. The global economy grows a little faster or it's a little weaker. Global financial conditions change, commodity prices change, and those variables changing will affect the sort of central pattern.
But it has a lot of momentum.
And then you also have historic error bands around the forecast, and including in this country, there's historic error bands around the historic data, just to make things even more interesting. And that has a knock-on effect on the forward forecast as well. But we haven't provided those error bands around the scenarios. The point we make, though, and this again goes to scenarios versus forecast, where the scenarios are useful is to give a sense of relative level of impact of the different assumptions. So again, to go back to the, if I can call it the WTO scenario, it matters how we get there for the bank's responsibilities. In other words, over the horizon with which we have to bring inflation back to target and have to keep the financial system resilient, it matters whether it's a smooth transition to that or not, the extent to which it's anticipated or not. Well, I'll leave it there.
We're going to move on. Wes.
Good morning. I want to talk initially about non-tariff barriers and then move on to some follow-up from some of the evidence we heard yesterday. Your less close economic partnership scenario assumes that regulatory and customs checks lower trade by 9% relative to the baseline, even though existing regulations are grandfathered and financial services can maintain access through equivalence. So could you just elaborate on why you're making that assumption, given that both the UK and EU economies are already integrated and closely aligned? So, you know, where do you envisage the divergence occurring?
Well, there's if I can start, there's a couple of issues. One is that we get into a position in a partnership, and again, it depends on the nature of the partnership negotiated, and you have to make assumptions around that. But you get, for example, into a position where rules of origin become relevant, and the question is it, and then you get into important but technical issues around whether it's accumulated rules of origin or final good rule of origin. In other words, do you pull everything up through the value chain that ultimately comes into the product that's being traded? So that's something that has to be assessed. First point. Second, whether or not
about 1.5.
What's grandfathered, or are existing product standards grandfathered? New products then have to be certified. Products and services have to be certified. In a less close partnership, potentially everything has to be recertified. Oh, yeah. That's a cost. Photosanitary and sanitary requirements, again,
UJ just cracked.
Those are also effective barriers. I think there is I can't recall the exact page. There's, well, there it is. Page 16 is a decent representation
I'm looking at, or
what's happened in the European Union in terms of those various types of barriers over the course of the last 20 years or so. Those are some of the issues. I'll make one last point, and I'll relate it again to financial services, which is one of the issues, of course, is some of these so-called behind-the-border barriers are discrete. That's a fancy word for binary. You're either authorized or you're not. And for financial services, in a non-passporting world, potential equivalence, autonomous equivalence world, the question is which financial services are actually going to have access from the UK into Europe. Now, we make a very clear assumption. I think it's clear, it's detailed, that we lose about half of the passporting rights in the close partnership. We lose about 3/4 of the passporting rights in the less close partnership. You can apply similar logic to other services. You can challenge both of those assumptions, but those are the types of issues that have an effect on trade.
Just bring in, I think, Mr. Woods, did you want to say anything?
No, I think Mark covered it well, but to illustrate the point on equivalence, there are 16 regulations and directives that include a notion of equivalence currently.
Said,
of those, only
just
3
went straight through that
really have
resistance.
anything to do with market access. So we've looked at that and thinking about how much of a step down would it be from the passported business today to equivalence as framed today, and that's quite a significant drop down, even if you're reasonably optimistic.
We're looking at.
Probably going to wait for confirmation and then re-enter.
One of the questions, and this kind of ties into
an ATR target on the daily.
some of the discussions we were having with the FCA yesterday. There's obviously the very likely possibility that almost near certainty that over time regulations and directives evolve.
I'm already at TV again.
How relaxed is the bank from a financial stability point of view and more generally about the prospect of the UK being a rule taker under any one of the options available to the government and to Parliament determining the way forward?
Well, we talk a bit about this, as you know, in the report, in Chapter 5 of the report, and we talked about it in the context of the submission we had prior to the referendum as well. And we start from a position, as the FCA does as well, I believe, but we start from a position, certainly FPC starts from the position that we have a huge financial sector in the UK, as you know, 10 times the size of GDP. It's the most sophisticated, most complex, and interconnected financial sector in the world. In that regard, in all those regards, you add all of that together, it's unique.
Next major
we
horizontal
would be uncomfortable.
resistance.
I mean, to give you a sort of basic, we would be uncomfortable not having some flexibility to ensure that it is appropriately regulated and appropriately supervised.
Wait for confirmation.
We would not be comfortable. Mr. Woods can speak to this, outsourcing supervision of this incredibly complex, incredibly important financial sector, but also one that in recent memory, I think everyone knows, and it's part of the reason why the Bank of England is structured like this. It's part of the reason why the Bank of England has a financial stability remit. It's part of the reason why the Bank of England has to release to Parliament when Parliament demands analysis of risks. That in living memory, that sector brought the country to its knees. Indeed. Mr. Woods, anything to add to that?
Yes, so I think we've all been clear in several hearings, including one I was at just a few weeks after the vote, about that level of discomfort about being a rule taker in financial services, and we could give you numerous examples. But to give you just one, we have literally, as we sit here, just completed the ring fencing of the UK banking system. Europe has gone down a different path. Strenuous efforts by our teams over the last few years to make sure that whatever path was taken in Europe did not cut across what we're doing here in the UK. Now, it's impossible to do that if you're not in the room and with the vote. So we have been very cautious about that. The only point I would add to what Mark said is we have also been clear in the submission we've made to you, and the FCA actually puts it in more or less exactly the same way, that risk is manageable its way through the European process. There's about 30 live files. There's 5 or 6 that we really care about. We've already been in there and managed to shape them in a way that is useful. So we're more sanguine about that aspect, but the longer term aspect, we're not.
So what about the hypothesis that Mr. Bailey presented to the committee yesterday? Because of the relative size of the UK's financial services and the role particular city of London as a global financial centre, what about this hypothesis that says, well, we may be outside of the room, we may not have a vote, but it's okay because we're so big, effectively, the European Union should worry about the UK as a rule maker and the EU having to respond in some way, almost not as a direct rule taker, but having to recalibrate their own approach to rules and regulations in response to what we might be doing here.
Well, if I could start, I could hand to Mr. Cunliffe, if I may, very quickly. Obviously, as per your previous question, Mr. Streety, it depends on the arrangement of the ultimate end state arrangement, whether we have the flexibility to make our own rules. So we can't have that dynamic of influencing Europe by making our own rules if we're not allowed to make our own rules, first point. Second point, this point of general application is, as Mr. Wood said, and I've seen this from the outside, the United Kingdom has had, as rightly so, tremendous influence and a very positive influence on the development of rules in Europe, and that's why I'm going to hand to Mr. Cunliffe, Sir John rather, because he's been there. It has done, and it's right, because many aspects of this system only exist effectively in the UK, and that's part of where the risk would come, because not through any malign intent, but just less understanding.
So John. Yeah, no, I'd make a number of points. I think the UK is as Andrew Bailey, I think, was saying, very highly respected in Europe for our technical expertise. And because we have an enormously complicated, a very large, comprehensive financial centre, we have expertise that isn't available to many other European countries. So
the others are stupid, huh?
Influential in the Basel Committee internationally in setting standards precisely because it's a large and complex financial sector. And I wouldn't expect that to change in general terms. But I've been in lots of European negotiation on financial services, and I've sat in, for example, some of the, actually chaired some of the meetings when we had the presidency with other countries in the EEA and the like, on reflecting others' concerns. And quite naturally, when you legislate, you take technical advice, but you legislate to fit the structure of your industry. And you see that across all sectors, not just financial services. And then part of the legislative process is countries say, well, my financial sector works in a different way. I'll give you one example from insurance, the famous matching adjustment, which applies to UK and Dutch insurance companies in a way it doesn't apply elsewhere. It took about 10 years to negotiate because that business model didn't exist elsewhere in Europe. And so I wouldn't expect, once the European negotiation process goes forward, I think technical advice on here is a way of doing something, international standards will play a role. But the voice that Sam was talking about, saying it doesn't work for us because the matching adjustment is something is needed for our companies in this and that I think is just going to be very difficult. And I wouldn't expect to have very great influence on those things.
We'll get to
yeah, just one. It's almost as if we've been negotiating bespoke deals as members of the EU for all this time, isn't it? But putting that to one side, final question then. In a scenario where next week Parliament chooses to reject the Prime Minister's deal, there will be, I think, all sorts of scrambling going on and people trying to land on a way forward. I'm unfortunately, I can't give you any predictions about what will emerge, but I think colleagues across the House, across party lines actually, have made it clear that they see either Norway for now or Norway forever as the landing kind of point to move beyond the sort of political impasse. How comfortable would you be from a financial stability point of view, but also thinking about how important a vote is around the negotiating table? Is that a sensible compromise, or is it a risk too far in terms of financial stability and having an effective voice in influencing the making of rules after we've left?
Just a brief,
John,
a brief answer.
Governor,
yeah. So John.
This went right between the two of us, actually. Yeah.
Let's start with Sir John, and the Governor will give you the final word.
I think our financial sector is about 20 times bigger than Norway's. It's much more connected internationally. It's much more complex. In terms of just how the EEA works, and my understanding of the EEA is that de facto, if not de jure, EU laws are adopted by the EEA countries and written into the kind of EEA annex and have force of law policed by the EFTA court, not by the ECJ. That scenario, I think, if you were to complete rule taker work for a financial sector this large and this complicated, would be, as the Governor says, quite uncomfortable.
The risk of being a rule taker goes up with time, as per Mr. Wood's earlier comments. From a financial perspective and financial stability perspective, it's highly undesirable to be a rule taker and to lose supervisory autonomy for any considerable length of time. We obviously fully respect, Parliament's whatever decision or whatever path is taken by Parliament will weigh a a wide range of factors, but if you isolate it into, which is what your question does, those would be the considerations.
Thank you very much.
John.
Our democracy is a little fragile at the moment, so it's worth repeating, perhaps in slightly stronger language, what our very diplomatic chair said at the beginning. This committee, and you're appearing in front of it, is part of our democracy, it's a key part of it. And this committee, which has very different views on Brexit, unanimously requested that you assist in our deliberations, and we might draw individually different conclusions. We might, as a committee, draw whatever conclusions. We might not be able to reach any conclusions, who knows?
I'm confident we
will. But it's actually quite fundamental, because what Rees-Mogg did was contemptuous of Parliament in suggesting that you weren't being straightforward with this committee. Contemptuous. And that needs stating quite loudly. It's our role, without hiding away, to hold you to account on what you say, to challenge you. Perhaps a few fiery exchanges might emerge. But we requested that unanimously, and that needs stating. So I'd like to thank you for providing your advice, your information, and for being here today, because it's vital as part of this country's democracy. I want to ask you about food. And I'm keen to get answers that the world can understand, because a lot of the debate on Brexit in here is almost quite technical, and my constituents scratch their head on some of it. With a no-deal Brexit, are food prices going to go up? Is that your assessment? And with a deal, the kinds of deals being muted, are food prices going to go up in this country, and also considering the derivatives market in Europe?
We have provided a, as per your request, and thank you for your opening statement. As per your request, we have provided a mechanical assessment of the impact of the tariff impact on food and beverages, and the net effect of that, plus the depreciation that could be associated. Again, it depends on the type of deal that is struck. Would increase the prices of food in the country. One would expect that would be. Sorry, this is it would be a one-off or a level effect that would. It tends to be the changes both to the exchange rate and changes in the commodity price of food are passed through quite quickly to the consumer. Unfortunately, it hits the shops pretty quickly, and then one wouldn't expect to see further inflation beyond that.
With respect, I mean, you're talking as an economist.
Yeah. Price of food.
Could you put that answer more as a human being? How much is food going to go up? What? Some examples. You know, if you're saying food prices are going to go up, people want to feel for what that means. How is it going to affect them? That's what they want to know, and that's what I'd like to know, please.
Okay. Well, they will go up in these scenarios. They'll go up for 3 different reasons, and you can tweak the size of each of these, and they are different in each of the scenarios. They'll go up because we would expect within these scenarios the exchange rate falls. Currently, we import a good quantity of our food, close to half, from overseas, so that makes it more expensive when sterling falls. That's exactly what happened, for example, after the referendum when the currency fell. We had higher food price inflation for quite a while. Second, because although this is an area yet to be determined as part of government policy, in these scenarios there are tariffs imposed on some of them. And third, because of the increased costs at the border, associated at least with the harder forms of Brexit. So those will have, each of those will be of different sizes in these scenarios. But the answer is that for those reasons, yes, you would expect food prices to go up.
That's don't tell me how much. Some people are saying food's going to go up 10%.
Yeah, that's
under some of these scenarios.
Yeah,
yes.
exactly. So, I mean, if you use on page 36, which gives that disaggregation that, again, talking like an economist, switch to human being, the tariff effect, about 5%. The exchange rate effect for each 5% depreciation, about 1.3 on food, and the food we would go into the whatever the Tesco's and buy off the shelf would add for each 5% depreciation about 1.5%. So in the most extreme scenario, so to give an outer bound, on average, your shopping bill goes up 10% because we have a 25% depreciation in that. If you go to a more orderly scenario with the transition, then it's something in around the 6% range. Now, for individual food products, obviously it's going to vary. But what people will do is what everyone does is that if the price of something goes up more than the price of something else, they switch products.
But I'm not sure my constituents, if the price of meat goes up, would necessarily all go vegan.
We wouldn't all go vegan, but we might buy a little more, local lamb as opposed to imported veal.
Is there a risk that food prices in the European Union will go up?
Yeah. Yes. Yeah. There is a risk of that for some products. But the flip side, our exchange rate is likely to go down because the relative for a period of time. This is not, and I should have said this right at the start, just on scenarios. Again, all of these scenarios are just out over the policy horizon of the two committees. So it just goes out to 5 years. We are not saying anything about WTO relative to close partnership in terms of relative long-term impact, which of course is the way people think about making this decision, is what's the long-term impact. But over the horizon, over the course of the next 5 years, it is likely in all these scenarios, everything else being equal, that the level of sterling is going to be lower relative to other major currencies, including the euro, and that will offset some of the costs to European consumers. They will get the benefit of their currency going up, while we get the added hit, if you will, of our currency going down for a period of time.
The other than people might not be bothered about, is it going to cost them more to buy a car?
Yeah.
Yeah, I mean, for similar reasons, albeit to differing degrees, and in the, therefore, according to which scenario you have. And the currency effect, as the governor says, over this period of time at least, would affect anything that's generally traded, whether it's food or a lot of manufacturers.
Some people suggest in WTO rules, if you buy a car from abroad, it'll be 10% more.
You've got
I don't know
page 35. It says the price of new cars is estimated to increase by 4%.
Yeah.
Clothing and footwear increased by 1.3%, and food and drinks and pubs, restaurants.
And then there will be a
1.6%.
separate currency effect, possibly. So the answer is the direction is clear. The size will depend on the nature of the withdrawal.
Governor, are my constituents better off since you've been governor?
Your constituents, yes, your constituents are better off in terms of real incomes over the course of the last 6 years, yes.
And this is part of the problem of economic analysis,
but whether,
isn't it?
Well, it's a precise thing. I mean, I'm not saying your constituents feel better off, but in terms of the proportion of your constituents that are employed, the hours that they're working on average, and the real wages that they are earning on average, as a group, are better off. But what they, if I may, what people in your constituency, I would suggest every constituency represented here and across the House, would feel is that the pace of real income growth, which has just in the last year has started to pick up and accelerate, but over the course of my time as governor, over the course of the time since the financial crisis more broadly, has been much slower than it has been in the past. And in fact, we're still in a situation where if you take that last decade, real income growth has been as weak. It hasn't been this weak since the mid of the 19th century.
Final question. Would you accept, Governor, that the way that the labour market is fragmented, the rise of agencies, the fact that many people in my area don't know how many hours they'll be working week by week, that means, in essence, when it comes to economic forecasting and its impact on people, that there's a danger that by having national forecasts, that we miss out the disparities between different communities, in essence, different economies within the country. And that can lead to a cynicism in terms of, people saying you're going to be worse off, you'll be better off.
Missed all the fun.
People say, actually, I don't feel that I'm any better off, because when I look at my
I got up for a minute, I looked at the charts, I went back to sleep, man. I actually set my alarm for
a brief
brief answer would be twofold. One is, I would accept, and I think I did just say that given the pace of real income growth over the course of even though the labor market has been quite strong in terms of jobs, the pace of real income growth has been slower. Your point about the variability of hours and the precariousness, if you will, of work sometimes has an effect. Can I make one last point, though, which is what we have seen in this labor market up until
I managed to make
but it popped and it's already friggin' retracing, man. That's
average hours has started to pick up. Real wages have been picking up, and
I
also
didn't get the whole
consumer
movement. I got some of it though.
About their own personal
a little bit of
economic situation, not about the general economic situation, but their own personal
exactly to resistance
across the country. So there has been an improvement.
It went exactly to resistance, pound US.
Certain regions, sectors, age cohorts. It
actually broke above.
Shared. That has always been the case, but it may be more pronounced at the moment.
It's pounds, so that means nothing.
Thank you. Governor, what proportion of the downgrade to the economy
pretty much just
in both of the banks' no-deal scenarios is down to loss of access
I would have got in and I'd already be in friggin' trouble.
It is proportion of downgrade. It would be really
just the
disruptive scenario. It's about 10% of the level
Canadian,
the 7% or so GDP. So it's 10% of that. In other words, 0.7 of that total. It's a lower proportion.
Hey, Swing, did you get a chance to look at that at all?
Effectively the same.
Yeah. I'm just fixing my computer. I updated my platform, and now I cannot trade anymore.
How many jobs in financial services?
But I'm getting to it.
Taxation revenue from financial services.
This pound
would be lost
went long on this pound dollar. That would be.
Have you done that?
We have not done that specific mapping.
But you know what's so weird is like I should be able to tell that because
what
it's
the
like
so-called day 2 or day 2.5
it generated a long entry, man, right off the weekly pivot.
In terms of the movements would be.
So what we do is set some bands around that.
See if I can get a reversal off of something.
The number of jobs that we expect to move, and indeed are moving, from the UK into the EU 27 at day 1, for banks and insurance companies, something a little bit south of 5,000, you might say around 4,000.
About 30 pips there.
That's a pretty small number in the context of those sectors overall. You could think of the banking and insurance sector employing 500,000 people, or the city is employing 400,000 people, or 1 million financial services jobs in the UK as a whole. The question is, where does that go from there? It is likely to be the case that that number increases somewhat in a benign scenario. In a more extreme scenario, I think the way to think about it is through revenues. And as Mark says, we haven't attempted to model that in a very precise way, but as an outer bound, if you like, you could think of 200 billion in financial services revenues in the UK, which around 40 billion come from EU 27 customers, of which perhaps around half, or something less than 20 billion, relies on passporting. Now, if you map that across, which Oliver Wyman did a couple of years ago, into a jobs number and include all of the other bits around that, the ecosystem, something like that, they came to a number of 75,000 jobs. That, I would say, is an upper end, not least because there are other ways that firms can trade across the border, and if some form of equivalence is found, then clearly that eats into that considerably. So those are the kind of outer bounds of the chart, if you like.
But the biggest risk there is what was said earlier, between 1/2 and 3/4 of passports lost.
Well,
is that correct?
Yeah, Mr. Hosey, if I may, that was, the 1/2 and 3/4 was in a close partnership. We're assuming that we're losing some of the passporting, which is a reasonable expectation given where the dialogue has been and given the reorientation of banks' business models. So I believed you were asking about the more disruptive scenario, in which case there would be a full loss of passporting. Then you get to the issue that Mr. Woods raised, which is, okay, so do you take that whole 20 billion of lost revenue for the city,
there it is.
The city and Edinburgh, and wrap that together, or do you expect that some would be retained through over time through other mechanisms of providing financial services? And the answer to and we would have some expectation that some would be retained, but it would take a period of time to develop those relationships that would allow that type of activity. I'll stop with this. It's quite often said, quite blithely, that banks could, quote, back-to-back transactions into London. Well, they won't be able to back-to-back transactions into London if there's no ongoing relationship in financial services between the UK authorities and the EU authorities. But with a cooperative relationship, that type, or elements of that type of risk sharing and risk transfer is entirely reasonable.
So what would you say to those economists who disagree, who will suggest that it would never be as bad as the complete loss of passport? It would never be 20 billion, it would never be 75,000 jobs. Indeed, there are opportunities that arise from a different sort of relationship. What would you say to them?
Well, I would say first, and we would say, and we have been saying to our European partners, is that it is absolutely in the interests of Europe and but both sides, Europe and the UK, to maintain a high degree of integration between these two systems, particularly in the areas that are most complex and most centered in the UK, because splitting them apart, everybody loses in terms of costs and others. So there are forces that would support the retention. But I would make this very basic point, which is this will be negotiated. This will be negotiated access. It's not just going to happen. This is now very clearly on the table. Everybody knows what the issues are. And the discussions between political declaration, importantly, is around access based on equivalence, as you know, while respecting autonomy. And within those two concepts, there are very many different outcomes. But it will not, just to re-emphasize the point, it's not something that's just going to happen out of sight of the authorities.
So, yes, sorry, just elaborate on two parts. That one does hear that it's fine. You hear two reasons given for it. The first is that before we had the single market in financial services, there was trade. There were different ways of coming across. We have the overseas persons exemption and the like. And the second thing one hears is that it would not be in the interest of the European Union members to actually put up the price of financial services or cut themselves off from some of the things that can only be done here. On the first point, just to reiterate what was just said and to emphasize it, that was a very different world when many of these activities were not regulated. And if you look at the regulatory agenda of the European Union now, the investment firms review that's going through, the review of market infrastructure regulation that's going through, there are steps being taken to regulate third country access in areas where it hasn't been regulated before. So this will be a negotiated and a regulated thing. I don't think we can go back to the way the world was 25 years ago. And the second point is I think for many European countries are concerned that the price of financial services will go up. But there is also, and I think I've spoken to this committee before about it, there is also a view in the European Union that they need to have control of their own financial services and bring as much as they can to the European Union so that it can have its own capital market, etc., etc. So it's not to me at all clear that the higher cost of doing things through Frankfurt rather than London will necessarily act as an incentive.
Okay, can I just move on, Sir John? In your role as Deputy Governor for Financial Stability, can you tell me what work the bank have been doing to mitigate the risks of a no deal? Can you give us an update on where we are and what's been achieved?
Well, we've set a lot of this out in financial stability reports. If I can split the risk into three main areas. And one is the general economic impact of no deal, no transition, an abrupt exit from the EU on the general economy and the way that impacts back on the financial system. And all I'll say about that is that's precisely the reason for the worst case scenarios that we presented, that are disruptive and the disorderly, is so that we can test the financial system's ability, the banking system's ability to weather that sort of general economic pressure on firms, pressure on households and housing. And we compare that against our stress test, and it's clear and it's set out in the report that the financial system has the capital, the resilience, the banking system, and the liquidity to actually weather that. So that's one area which we can explore further if you like. The other area is, are there areas where there is cross-border trade between us and the EU in financial services, where if there were no permissions, if there were no equivalents, if passporting is lost, there could be difficulties. The FPC has been preparing and publishing a checklist of that, of those issues for, I think, over a year now. And we've isolated the largest issues. They were around derivatives, cleared and uncleared derivatives, insurance contracts, and data. And the conclusion we've come to on those that, if I could take them in a particular order, that on insurance contracts, the problem has been mitigated over the period by the fact that a number of UK insurance companies selling into Europe and European companies selling into the UK have set up UK entities or European entities and transferred those contracts. And in the UK, the risk is, I think, taken away by now the ability that Parliament has given us to have a temporary permissions regime so that European insurance companies can operate in the UK. On the European side, we believe there still is a risk. It's gone down, but I think by memory it's about 9 million policyholders in the EU may not be able to depend on the UK insurance companies because the companies won't have the permissions to do what they need to do to pay claims. On the derivative side, for derivatives that are not cleared, and at the moment in terms of notional, I think we've got about 28 trillion notional of uncleared derivatives, of which about 13 will exist after the 29th of March next year. That number is growing. The contracts, we think, will be safe after Brexit, but the ability to perform the so-called life cycle events that firms use to manage their financial stability risks will be a doubt in a number of jurisdictions. There is no answer. The firms cannot move those contracts, and from the perspective of the FPC, there is a risk there that were we to see a market stress in the event of Brexit, that some risk mitigation mechanisms that are normally available to companies won't be available to them. And then the last one I'll mention is clear derivatives, where we're about 60 trillion notional, with 40 trillion maturing after Brexit, and that maturing after Brexit number is growing, which we've discussed in front of the committee before, where I think, again, on the UK side,
cool, looks like just a better entry, that's all.
We can deal with it. On the EU side, I think there is now a recognition that there will have to be temporary recognition, temporary permission for UK clearing houses who operate in Europe. And we've had some more details I think, since I last spoke to the committee about what's required. But as the
so what did you say, Swing? You're doing what? Fixing your computer?
The clearinghouses actually need a bit more definition on the conditionality.
Yeah, there's an update for the new sea trader, and I cannot log on to anymore.
One very brief question.
It looks like I got it fixed.
I barely hear you. It's kind of echo, man.
Press release about the UK withdrawal and the ability to facilitate innovation of certain non-centrally cleared OTC derivatives. Does that not deal with...
No, it doesn't. It deals with a rather small aspect of the issue and not one that goes to the points I made. Right, so if on the unclear derivatives, if you want to novate them across,
there's why,
then certain European Union rules could make that more difficult. And what ESMA has done is said that they would waive those European Union rules to allow the legal transfer of those contracts.
But it doesn't deal with the whole problem.
But it doesn't. It doesn't deal with the overall problem, and the contracts, the whole stock could not be novated now.
Thank you. Charlie.
Good morning, Governor. I want to ask you, and everyone else indeed, I want to ask you about preparedness for no deal. Representing Dover, I'm always warned that there'll be massive queues of lorries on the way to Dover. But then I looked at ports like Felixstowe and Southampton that trade with the world as a whole under WTO terms, and they don't seem to have any queues. So my question to you is, what evidence have you gathered on whether the UK's border infrastructure is or could be prepared for a no-deal scenario, and what steps, from the evidence you've gathered, has the government taken to do that?
Yeah, good morning, Mr. Elphick, on behalf of all of us. I mean, these are important questions. We're not and let's be clear, we're not we have gathered evidence. We're not the experts at Department of Transport, at the port authorities themselves, Associated British Ports, others, logistics companies, but through our agencies and through direct visits by members of this committee, we go and meet with these ports and we assess the situation. One of the challenges, as you'd be familiar, one of the many strengths of Dover is that it's highly specialized. It's highly specialized in roll-on, roll-off ferry transport, so-called RoRo ferry transport, and one of the issues in terms of displacement of, in the short term, that capacity to other ports, whether it's somewhere like, say, Southampton, is that the infrastructure is not in place for those types of ferries. So some are, as you know, container ports as opposed, so low as opposed to ro-ro, and these distinctions matter. So it isn't simply a question of the additional distance to travel to the ports or the additional distance to travel from the ports to the ultimate customer for the materials. Our assessment is that at present, our assessment, which is consistent, I think, with parliamentary testimony to this committee and other committees, whether it's Department of Transport, whether it's HMRC, whether it's the ports themselves, whether it's the users of the ports, some of our major manufacturers, is that at this point in time, the ports are not ready for a move to an administered WTO relationship. So what do I mean by administered? I mean we move to a WTO relationship, and there are the customs checks that are consistent with that on both sides of the borders. And I'll finish with 2 points just to reinforce. The first is, to be absolutely clear, our agents, my colleagues, we have gone to these ports and had these discussions directly with the ports in questions. We've talked to the private logistics companies, so we have gathered direct information on this. Of course, there are those who are better informed from your own contacts and discussions with people, which is that there's sometimes said that what if we just don't apply the new standards for a period of time until we're ready, which is an attractive, in the crux is an attractive option, or would appear an attractive option. The issue is if the new standards are applied on the other side, because the truck that comes here has to go back, and a truck that goes back empty or has to wait isn't going to come here in the first place. And that's something you learn in about 5 minutes when you start to have these conversations, whether it's with the logistics companies or the ports themselves.
So as you know, the European Union sell us twice as much in the way of goods as we sell the other way round. And I read in this document the assumption that you make that there'll be friction outbound to Europe and that we will continue to allow free-flowing goods to come into the UK. And my concern with that is, why is it that that assumption is made? And is it, and nowhere in this document is the word substitution used. And I think that's quite important, because if there were any friction at the border, in a globalised economy, markets substitute very quickly, and you haven't modelled in any way any kind of demand increase and fulfilment of demand by domestic production increase or from other areas, and indeed the wider impact on the European Union. I just want to ask, what are your views on the possibility of substitution?
Well, first thing is that's not accurate. It may be accurate if you did a search that the word substitution isn't occurred, although I'm not sure that is strictly accurate. But certainly the issue of import substitution is part of the modeling here. So there is import, and that is discussed in the report, and that is part of the modeling. First point. Second point, a big element of trade modeling, and what would happen, of course, is that there would be so-called trade diversion. So as soon as you change the relative cost of exporting to Europe, which is what's going to happen on whatever form of Brexit we have, British entrepreneurs are going to sit there and say, well, it is now relatively more attractive for me to export to the United States, to Canada, to Japan, wherever, even though the price of exporting there has not changed. The relative attractiveness has changed. And so there are those elements in that trade diversion in the modeling that we have done. But let's go back to your core point and go to the what we have done and why. And I'm going to re-emphasize a couple of things. One is scenarios, right? So if you think that Dover is going to be ready, if you think this is going to be seamless, if you think that it can be substituted to Felixstowe and to Hull and to Southampton and all the other great ports around the country seamlessly, then you have a scenario which gives the pure economic effect of trade and non-tariff barriers in the best of our judgment, which is a smooth WTO scenario, which is located in this report, and you can use that as a basis for your judgment. Then you can interrogate other aspects of those assumptions.
Or indeed cooperation between Dover and Calais and Britain and the European Union and all the trading scenarios if you think which you've not modelled.
Sorry, it is modelled. It is modelled. Okay, don't assert what is not correct.
But that is a possibility that one could have.
It is a possibility, but there's two things. So my second point, which is the fundamental point of, so what's the core thing I would expect that the Treasury Committee would expect of the Bank of England, which is to make sure that the one area over which we have the most influence is ready for whatever form of Brexit the country chooses. And that's the financial sector. So when we look at the financial sector and we look at the potential impact of not being ready in terms of port infrastructure and other aspects, and I think we would, well, maybe most of us would accept, but anyone who's actually going to the ports and talking to the ports and talking to logistics companies would accept that at this point in time, on December the 4th, 2018, they are not fully ready, okay? What we then do is say, given that that is a fact, and a fact that might not be fully remedied by March 30th, 2019, we then see what the potential impact that would be on the economy, therefore the financial sector, and we have made sure that the one thing you don't have to worry about is whether the banks have enough capital and liquidity that they're managing their risks in a way. They are going to buffer this issue if there is an issue. They're going to buffer it. They're not going to amplify it. And that is an entirely different position than this country has been in for quite some time. So that's what we do, and that's why we look at that. But if you, and just to reiterate, and I'll stop here, that if you, based on your intelligence and information from the companies or expectations of when Department of Transport is going to finish their 17 projects, and HMRC is going to, shift the 11 of 12 that aren't ready to 0 of 12 not being ready, that all of those things are going to fall into place. If that's what you expect to happen, then one starts the conversation on the smooth WTO scenario in terms of potential risk. And we're already sleeping soundly at night because we have the financial sector, the core of the financial sector, in a position that it needs to be for a tough scenario.
Let me talk.
And if it moves to an easier scenario, then a fortiori we're in.
Let me move on then, Governor, just to talk about the financial sector side of things. We took evidence yesterday from the NIESR, who looked at the disorderly bank rate rise of 5.5% interest rates, and they've published an analysis that found that market expectations of interest rates were not rising in response to the bank
looks like
warnings.
all the fun, everybody's asleep.
Do you think that markets are not finding these warnings that you put in your document to be credible?
Well, I think the markets have to make an assessment of what they think is most likely to happen. First point, and that is expressed directly with respect to the currency, and then secondarily through interest rate markets. There has been volatility in sterling, but there haven't been dramatic moves in sterling. So in terms of the risk premium in market for a more disorderly scenario, well, there is some developments in option markets. There's less in the underlying price. That's the first point. The second point is that, and I would agree with the general. I didn't see the testimony yesterday, but in terms of rate expectations, still relatively modest rate expectations. The market, apropos of an earlier exchange on whether or not this was how unprecedented this was, the market hasn't experienced something like this. Or very few in the market is probably a better way to put it, has experienced something like this. And the market has been in a position that, certainly for the course of the last decade plus, that every time something difficult happens, central banks provide stimulus.
Do you have a final short question?
Very final short question. Andrew Sentant, who used to work with you at the Bank of England, has given evidence to the committee. He says the Bank of England analysis appears to have thrown in the kitchen sink to create the most negative scenario possible. In particular, the bank analysis assumes the official bank rate will be raised to 5.5% as the economy is moving into recession. He says he finds this totally implausible, and particularly given that you have a history of being reluctant to raise interest rates. What is your reaction?
Well, I think I'll stand by our record and my voting record, if you will, of my time on the MPC, which didn't include any overlap with Mr. Sentence, in terms of the economic outcomes, including the balance of the path of inflation and activity and employment. Second point I'll make is that it is not an assumption of the path of bank rate. It is a calculation. It is a the sum of squared deviation of deviations of inflation from target and output from potential that is calculated. And the third point I'll make is that there was a time, maybe a simpler time, but a less successful time, when all the bank did was focus on inflation. And we know how that turned out. And the consequence of that was to bring a new committee in place and new responsibilities, which was to manage financial stability. The consequence of having the FPC in place is that the financial system is ready for Brexit. And the reason the financial system is ready for Brexit is because we stress the financial system to the kitchen sink, which is what you would expect. Because if we end up in a scenario, by accident or design, where we move to a situation which, despite all expectations, put it that way, there is some disruption in terms of trade, in terms of the ability of the economy to seamlessly adjust to substantial change in trading relationship. The financial sector would be part of the solution. And on that day, you will rightly expect us to have done our job for the last 2 years. And doing our job for the last 2 years is not just about sitting there fixating on price stability. We're delivering price stability, but we're also delivering financial stability.
Thank you. I'm going to remind people to get answers short, as well as members keeping their questions short. I'm going to move to Alison. I just want to ask you one question, Governor. At our request as well today, you have brought forward the publication of the survey by the bank's agents of firms' levels of preparedness for EU withdrawal. So thank you to that. Thank you to the agents. Just in relation to Charlie's questions about preparations for ports, can you just explain perhaps how the agents' work feeds into or has fed into the report before the committee today?
Yeah.
I don't know what
why don't I pass to Sir John,
okay.
In part because he was in your constituency in the past few weeks.
I had the fortune to go down to Dover and to talk to people there about what was happening. But actually, this is what I heard in Dover is set out. It's basically the same picture that the agents have reported. How has it fed in? Well, we had the agents' responses, some of the earlier agents' responses. The survey wasn't completed when we started preparing the report for this committee, and we've tried to keep the report for the committee sort of in line with that survey as it went along, even though we didn't have everything in. But of course, this is the final set of results. I think just in terms of what it shows, and again, this is what the agents are told, and they visit the ports, logistics companies, haulage companies, etc. What it shows is that there are a number of different things here. First of all, I mean, it's entirely right that a lot of trade comes in from outside the EU without going through lengthy checks, but that's because it still needs documentation in a number of areas. It needs customs documentation around tariffs and duties and rules of origin. It may need regulatory approvals depending what's being transported. It needs security clearances and the like, and all of that is done in advance. And if you then say for the half of the trade that we do with the EU, can those things be done in advance? Could we get to those systems? The answer is one could get. I don't think one gets to the frictionless that we have with the EU, but you could get to a system where much of this, or a great deal of this, was done in advance, was computerized, but it isn't done now. And for 92% of the 4.5 million trucks that go through Dover every year,
you said take profits on a truck line. How are you doing that?
There is no check that documentation has been done. For the 8%,
I made a machine who does that, but it didn't work with the old Sea Trader.
They go to a place outside Dover.
Does it work with a new Sea Trader?
60 minutes.
Can I have it?
Yeah, sure. There is a download link in the README.
So the first thing is that there would be checks needed to be done.
But this is very, very beta. I'm still working on it.
Which comes out here.
I'll get it running on my demo account.
The second is if these checks
TL Trader
certificates, permissions, and the like.
What's this siege going on with Morbo?
Is there the ecosystem?
It's completely nonsense, I guess.
Handle this new load? Will firms, small businesses be able to fill out in short term, know how to fill out customs declarations?
Well, I turned him back on, and I didn't know it was
250,000 firms may have to start filling those things.
And what's weird is I'm not getting any of that on,
do the authorities,
on my
customs, DEFRA, etc., have the systems in place to be able to deal with that? So I think the answer that you get through this is
just talking about transportation and shit.
Happen at the border, and when you
look at what needs to be done by the authorities, and when you look at where firms need to be.
So, Swing, did you isolate where the code is that you need to change on that?
Yeah. It actually counts candles.
Have the systems in place